Let's go ahead and bring in Alexandra. She just joined us. Thank you for joining us. What are your thoughts? Give it to us.
You don't mind that I sum up where I am? I didn't listen to any of what you've said so far. I'm getting old. I'm doing this really slow, but let me sum up where I am. I actually think the positives by far outweigh this Q4 earnings. I like that they said we're positioning ourselves between the two growth waves of the Model 3Y and the next generation coming. So we're in this intermediate phase. You have to have the time to sit out 2024. And I know for those that have the feeling that 2022 and 2023 were already difficult to sit out, well, you're going to sit out one more. COGS are down to 36,000. Shout out to Jeff. He's been telling us for months that this is coming, and here we are. Auto gross margins now stabilizing at 17.2. That's good. Free cash flow was for me the biggest good surprise because I didn't expect much, yet we had actually 47% of the 2023 free cash flow now in the fourth quarter. We're back to 4.4 billion for the whole year. That's good. That's giving us our 29 billion of cash. That's actually putting in question what I've been calling for, that we need a capital raise soon. They are saying it very clearly. They think they can stem everything with what they have. All good to them. I mean, I'm always looking at the other Mag 5 because Amazon doesn't give their research and development numbers. So compared to them, I found research and development numbers from Tesla low. I know they are lean and mean. I love that, but I just want to make sure they have enough money for everything they want to do. Operating margin together with the auto gross margin have bottomed 8.2 now. We're up from the 7.6. Energy growth and profitability were great, but the accounting Q4 is choppy. We have Matt with us. He has been telling us for years, this is always difficult to see which quarter they come in. So there is something coming soon. The whole CapEx for 2023 was just short of the 9 billion they guided, 8.89, and with a clear mention that this is really going all to AI and research and development. Now, research and development in Q4 was 1.28 billion. So total research and development was 5 billion. I mean, that is a good number. I'm not saying that's not good, but compare that, I'm doing that again, with the other Mag 5, that is really low. So just, hoping that it's lean and mean. 800 million FSD beta miles worldwide. That's great. And obviously the big elephant in the room, there's no clear guidance yet on 2024 volume growth, maybe notably lower than the growth rate we had in 23, which was 38%. Energy should outpace auto. That's a big statement. I mean, we'll see what that happens. And then, James not here, but maybe somebody else knows. What's this 5.9 billion one-time non-cash tax benefit? I mean, that is just crazy. 6 billion, here they are. Wish that would happen to my bank account from time to time. But that, I mean, I know it was non-cash, but still. So other than that, I thought it was really, encouraging to read. I'm not surprised that the stock hardly moves, but I mean, what can they do with that? They have confirmation on the couple of numbers that they were looking for. They don't have their guidance. So now it's all waiting for Elon. Did he take his vitamins today or did he not?
Thank you. That was such a perfect summary here. We also have Gary in the background, but Gary, I don't know if you can hear us, but you're gray on here, or actually blacked out. Gary Black is blacked out. Look at that. Perfect. So I would see if you can restart your machine that you're using, Gary, and then we can bring you back in. Any questions from Alexandra before we bring in our very special guest, Elon Musk?
Yeah, quick question for Alexandra. I'm curious on what your take was on the outlook for volumes in 2024, how you interpreted that.
Well, I think they don't want to put a number in writing, right? So for me, this is at the moment rather negative. I would have liked a 2.2 or whatever, or I would have liked a certain percentage saying, okay, we'll match this year's 38% or whatever. But let's wait and see what he says. It just seems that they are a little bit stuck between a rock and a hard place. What is happening with interest rates? What is happening with our worldwide expansion? How long will it take until we have that next gen car? How quickly can we produce? I don't know whether you've seen that on Twitter. Somebody seems to know that the first 50,000 Cybertrucks will all be foundation models. So how quickly will they push those out? So there seems just to be so many question marks that they didn't want to be precise, which I don't like. And you know me, good old German lady. But I'm giving them the benefit of the doubt until we hear them later on.
I think it's well said.
Let me see. Gary, can you hear us?
I can.
Okay, we can't see you, but maybe actually this is perfect. Look at this. Gary Black in the black. I love it. Living up to your family name. What are your thoughts here, Gary?
Well, they didn't guide, and that's the reason the stock's down. The margins were better than people thought. The gross margins came in at 17.2. And as Jeff said, I look at COGS per unit was down about 8.5% year to year, and ASP was down about 16%. So that's why you had auto gross margins come in better than people thought. The earnings number was 71, which that really doesn't matter because if you looked at other expense line, it was like about 3.5 cents of noise. I don't know what it was. They don't tell you, but so the real number is like 74, 75. But because they chose not to guide, that's why people are uncertain. I mean, that number could be, 2 million for this year, and it could be 2.4 million. And because they didn't guide, that's why people are pissing out the stock. So maybe they'll clarify that on the call. Hopefully on the call, they'll give some, hints about what they're going to do with pricing this year. But, Wall Street hates when companies have guided every year, and then this year they decided not to guide. And, that's negative, obviously. And until, I don't think the comp plan matters that much. I think it'll be in line with what was, let's say the Delaware court rules that last time was fine. It'll be similar to last time. I don't think that really resolves anything. They've got to give guidance, though. You can't just stop giving guidance because, you think the economy is going to be uncertain. I mean, everybody who guides then continues to guide. And once you stop guiding, you're looked upon as being, negative. So that's why the stock's down. Everything else was okay. I mean, the numbers were fine.
Okay. Did you remember to turn on the light in your room, by the way, Gary? Are you working in the dark there?
No, it's light in here. I don't know why it's not showing me up.
Gary, what's your thinking about other investment analysts? I saw Gene Munster come out and saying he was quite happy with the auto gross margins, and for him, that was the most important number. What do you think the others? I know and headlines is going to be the notably lower than the growth rate achieved in 2023. That's the mainstream media. What do you think the investment analysts will say?
Again, the numbers are good. I mean, auto gross margin was better than people thought. Bloomberg was 16.7, I think, and this was 17.2. I know FactSet they were saying on CNBC was 15.7. So the margins came in better than people thought. The problem is they didn't guide, and there's no discussion about pricing, and there's no discussion about auto gross margins going forward. So hopefully on the call, they'll be a little bit more clear about where the volume goes. Remember, the street's at plus 21 for year over year, and last year was plus 38%. So, they don't have to give you much. They can just tell you that, it's going to be up about 20% or something. And then there has to be some hint about what pricing is going to look like for this year. Will they continue to take pricing down? Will auto gross margins stabilize? And so that's what you're going to hear from everybody. They're all going to talk about auto gross margins were good, but there was no guidance, and that's why the stock's down.
Okay, but Gary, you saw the cost of goods fall by $1,000, right? So are you taking that into consideration? Huh?
Yeah, but that's not, everybody can see that though, Herbert. So I'm telling you, that's why auto gross margin came in at 17.2, because cost of goods was down on a per unit base, down 8.5%. That's a good thing. But if you're not guiding, that just tells you that maybe the numbers are worse than people think. If you look at Model Y inventories in the U.S., they're pretty high right now. One would think with a $7,500 off invoice credit, they should have some visibility about volumes. But when a company decides suddenly not to guide, that's always viewed as a negative. The knee-jerk reaction among institutions is sell and ask questions later. I'm telling you, if they decide to clarify their guidance on a conference call and say, well, we're going to be 2.2 or 2.1 or something, then the stock will go back up. But that auto gross margin was a good number. It's just they didn't guide for volumes. They didn't give any guidance.
I think one thing that's interesting about that, though, is that if I remember correctly, back in Q4 of 22, they didn't guide for 23 until Q1. If they're consistent with that, do you think that's going to change the story?
We could wait until the end of first quarter and see what they say. But, last year they guided at the end of fourth quarter. The year before, I think they guided the end of fourth quarter. I could be wrong, but when companies don't guide, investors assume the worst. It just calls into question, are they doing well or not? The two most important metrics in the whole P&L are volume and auto gross margin ex reg credits. And auto gross margin ex reg credits for fourth quarter was decent. To your point, COGS was down 8.5% year over year on a per unit basis. It was 36.3, but the average selling price is down 16.3. So, hope on the conference call, somebody will ask them about their pricing, outlook going forward, and they may not say anything. But, the street right now, I think for 2024 is about 17.7 for auto gross margins. So if, they give some sort of hint that says, they're not going to cut pricing that much more aggressively, that would be good. But the fact that they didn't guide for volume when they have in the past, that's a concern to people like me.
So a couple comments too. I agree with what Gary's saying on the guidance. This is Jeff, by the way, Gary. I think that 3.5% or so of COGS reduction quarter on quarter is almost unheard of in both in
and
auto.
I look at year over year.
No, I'm not. Yeah, I'm not done. So first off, the year on year performance is actually really good. It's very good. And if you start dissecting the recent price cuts, like you take the China one, for example, the Europe one, for example, if you do that aggregate across all their volume, it comes out to about 0.6% of MSRP, and they just printed 3.5% COGS reduction. So I think I forecast more pricing reductions, but in line with their COGS reduction program, or they may even exceed it. The question isn't to come down to volumes. There is going to have to be a question on volumes. Are they going to be relatively flat and still printing good numbers? So they're utilizing their factory capacity, they're utilizing their supplier capacity. That's going to be key. The other thing I think will happen, I can talk about this probably on a whole separate show, is they use this statement about natural COGS reductions, and at some point reach exhaustion in some of those things. And so, especially if volumes are flat. So then you have to introduce unnatural options. And maybe I'll talk about that when there's more time. But they have a lot of unnatural options in front of them to really put on a fabulous COGS reduction program, as they introduce the next vehicle. Because which of their suppliers are not going to want to get a shot? If you're a Tesla supplier on the Y, you ship a part on the highest volume vehicle in the world. You get the best fixed capital leverage, you get the best labor efficiency leverage ever. So you're going to do whatever you possibly can to get a slot onto the next vehicle. And that bake-off, that Reuters leak, that's starting now. And so anyway, I think there's opportunities throughout the year for that. And that's how it actually works in real life. The other thing, they have out there is the bot. And I believe that is approaching some sort of design lock over the next year. It'll be a rolling design lock, but something that they can build more volume of. And same thing there, supplier selection, bake off, everybody wants a shot at that. So anyway, it's something for a longer broadcast, but I do think they use that term natural for a reason, because they have a lot of unnatural options. Finally, their inventory reduction, their DOI going to 15, coupled with the very high COGS reduction, that is a machine. That's not, they're not getting sloppy. That's not like like they're coming out of 2023 and inventory built up and gross margins did this, and they're not forecasting volume. They're running this machine on inventory and COGS reduction. It's literally a masterclass. So if anything, I think they're positioned well. It's a question about if they comment on volume guidance in any respect.
Unmute yourself.
Do we have special guest Elon showing up soon, or we got the call coming? I thought he was going to show up here before the conference call.
Gary, you're muted.
I agree with what you're saying, Jeff. I'm just saying the volume numbers are really important to investors, and unless they clarify it, the stock's not going anywhere. It may not go down. It's down about 3%. It would have been up if they had just guided to where the street was, which was 2.2. It would have been up, a few percent, because to your point, the COGS number was good, and everybody knew what the pricing number was. And so, when you see 17.2 auto gross margin and FactSet was at 15.7, that's a big beat, right? But they blew it, and I don't know why. I don't know why they didn't just give some sort of number just to provide, or even give a range, And so you already have, I read some analyst saying, well, the volume number is probably about 2 million for 24. Well, they don't know that. The company's not saying that, but this person, has taken it upon himself to impute that from the lack of saying anything. So I don't know. It's just disappointing because the quarter was actually not that bad.
Yeah, one thing I wanted to highlight also, if you just look at what they have in their stated production capacity in the deck, it's over 2.3 million vehicles. Now, if you back out Cybertruck, because that's ramping, whatever, you're still at 2.225 million, which is, I think, plenty of growth year over year, but they're basically saying they don't want to even guide to what they've got in capacity. So I think we're all sort of expecting them to produce less than their capacity, which is a bit of an odd situation for Tesla. So that's something that's a little bit different. And I wonder if people are kind of looking at that and doing that math also.
Okay.
Yeah.
Go ahead, Jeff. Real quick.
It's a quick answer on that. The key on that is using roughly about 80% of that capacity. That's benchmark in the industry. And what Tesla does is they leave the year with a capacity number, then they slowly add capacity throughout the year. So that may change, that regimen may change that this year, to your point. But the key is they'll probably use less than that. But as long as it's 70% is actually really good from a utilization perspective. They can keep it above 80, they'll be in great shape. The rest of macro auto's in a much worse position when it comes to utilization. So, but hear your point.